Welcome to the latest episode of Quest for Twice. Today is May the 18th. I'm going to cover several earning updates. The first one is Ingredient. So just recall that the Ingredient Q4 earning was disappointing for a number of reasons I documented before. The first one was high corn price inflation. Another one was a slow ramp-up of new plant and COVID-related labor as well as transportation issues. So fast forward 3 months. Some of the issues have been resolved, which I crossed out on this slide. The corn price inflation actually got worse due to the Russian invasion of Ukraine. For this reason, I sold most of my ingredient stock because I was concerned that its margin would be compressed due to the high cost inflation. So when the management reported the Q1 earnings, I was pleasantly surprised because the quarterly sale came in at around $1.9 billion. That's up 19% year on year from Q1 2021. That was $14 million. Also, the gross margin came in around 20%. That's a small reduction from 21.7% achieved 1 year ago. But that's still fairly high compared to the 3 other quarters in 2021. The bottom line is Ingredient had no problem to pass on its higher input cost to its customers. That shows its pricing power. Ingredient protected its profit margin and increased its sales mostly due to passing on the higher input cost. Its adjusted operation income came in at $213 million. That's actually higher than $201 million 1 year ago. And that exceeded its previous guidance around $180 million. For the whole year, the adjusted income is about $760 million with a CFFO of $620 million. That translates into earning per share about $7.15. At $87 per share, its PE would be about 12.2. That's fairly low for a company with underlying growth drivers in its specialty ingredients, as well as pricing power to pass on input cost in this inflationary environment. I admit I was wrong when I made the decision to sell ingredient stock because I underestimated its earning power. So I will start to buy back ingredient shares during stock pullbacks. Upstart also reported the earnings last week, and its stock price was hammered. It's the first time in my portfolio that one stock lost 50% of its value in 1 day. So that's a very severe response to its earning report. So let's take a look at what happened. Its revenue in Q1 2022 came in at $310 million as shown in the chart at the bottom right. So that's a small increase from the revenue in the previous quarter. But importantly, the management lowered its full-year revenue guidance to $1.25 billion from previous guidance of $1.4 billion. The bottom left chart shows the revenue in perspective related to the revenue in the last 5 years. So 1.25 would be a still very fast growth. However, the management gave guidance for the Q2 revenue around $300 million, and that would be a decline from previous 2 quarters. So that's not supposed to happen to a growth company. And that's one of the reasons why Upstart's stock price was severely punished. The reason behind the lowered guidance was because of the fast rising interest rate environment. With a higher interest rate, it'll reduce the number of people eligible for refinancing of their personal loans as well as their car loans. It also reduces demand for new loans. That's why the management reduced its revenue guidance for the full year. So is the growth story broken for Upstart? Let's take a look at the growth drivers I outlined previously. A key driver in the past was a better conversion from increase to sales. So in the last quarter, the conversion rate was 21.4%. That's lower than the conversion rates in the 4 quarters in last year. That's because of the higher rate makes loans less affordable to potential borrowers. And also fewer borrowers eligible because the loan principal and the interest payment will be too high compared to their income when their loan interest rate is high. And also, as I mentioned, the auto loan refinance becomes much more difficult to make financial sense because of higher interest rate. So as a result, the management withdrew its guidance for the auto loan volume of 1.5 billion in 2022. So definitely, in the short term, there is a strong headwind from higher interest rate on the growth of Upstart. For the longer term, a good story is Upstart increased the number of dealers having its Prodigy software. The software itself is just a utility to streamline the automobile purchasing process for buyers. So that's to facilitate the transactions between dealers and shoppers. However, in the long term, Upstart will use the same utility tool to market its loan offering for new auto purchases. So that part of the growth story is intact. And a quick update on the moat analysis. As I mentioned before, the network effect of borrowers and lenders are not there yet. However, Upstart did increase its banking and credit union partners in the latest quarter to reach the number of 57, comparing to 18 1 year ago. So banks still show interest and conviction in the quality of the offering of Upstart product. Upstart also provided some information about how it evaluates the risks compared to conventional approach using FICO score that's shown in the matrix on the top. The more interesting part to me is that if we look at each row, that's for a constant FICO score band. Upstart assign drastically different default rate based on Upstart's its own assessment. For example, for the middle row of 660 to 679 FICO score points, and the low is 0.7% default rate under A+, and 8% under E-. So that's a very big spread. So that tells me Upstart has a way to differentiate the borrowers, even they have a very similar credit scores. And if we look at the default rate for each column, that means Upstart deemed those borrowers have similar default rates, despite they have a very different FICO score. We can see that, for example, under band B, and the least default rate is about 1.9%, and the highest default rate is 2.1%. Despite those borrowers have a FICO score of 639 or lower. So that difference of 0.2% is extremely tight. That supported my previous assessment of switching cost as a moat. And because Upstart can price credit risk more accurately, and that shows the quality of its product. And also, it has been doing the loan automation very fast and cheaply. Then there is a switching cost for its banking partners. So let's take a look at the threats and the opportunities update. Upstart also provided its in-period default rates comparing to its benchmark. So in the last several quarters, the loans have been outperforming its model prediction, mostly because of the government stimulus. So basically, the government sent the money directly to people so that the borrowers are much less likely to default if they get saving in their bank accounts. Recently, that outperformance has disappeared because of the disappearance of the government stimulus money. That's not an indication of the accuracy of the Upstart's model, given that the government stimulus or lack of it is really, it doesn't have precedence in the past. So the artificial intelligence needs past data to train. Without that data, then it would not work. One threat I did not identify before was the sensitivity of Upstart business to the credit cycle due to the interest rate fluctuation. So I underestimated the interest rate impact on the overall demand of loans. And that explains the near-term headwind on Upstart's business. So that's something I realized after seeing the Upstart's latest earning report. An additional threat was the loan on Upstart's book. At the end of Q1 2022, that amount stood at $600 million, comparing to $252 million at the end of 2021. According to the management, most of that money was because of the R&D purpose for auto loans, given that Upstart is just starting to offer auto loans. So it needs to use its in-house funding to loan to borrowers of auto loans, then get their repayment data to train its AI model. However, there is also a component of due to the very dynamic interest rate environment, the Upstart had a difficulty to sell its personal loan to the asset-backed security market. As a result, it has to carry those loans on its own book. That's actually against its business model of just providing a platform. The market really didn't like that change. That's also one of the key reasons why Upstart's stock price was hammered. But if we put in perspective, up to $150 million of personal loan was on Upstart's book due to the difficulty to sell to the ABS market. That compares to total transaction volume in the last quarter of $4.5 billion. So that's a small amount. The management indicated that they don't believe this is a normal situation, and they intend to sell that portion of the loan to the open market once the interest rate stabilizes. So my key conclusion is Upstart as a company has a high risk and uncertainty given it operates in the financial business. It's always possible that there will be additional risks and threats pop up that to me at this point are unknown unknowns. However, I do believe the underlying growth story is not broken for Upstart. The market is overreacting to the temporary headwind from a very fast interest rate rise, as well as resulting in the chaos in the ABS market. Let's take a look at the valuation. This chart shows the weekly price for Upstart stock. So in the October, Upstart's stock price reached $400 per share. Before the latest earning came out, its stock price was about $80 per share. And when earning came out, it was cut to half and dropped below $40. Then had a small rebound in this week. So at $40 per share, its price over sales is about 2.6, using its latest revenue guidance of $1.25 billion. That compares to about 5 for Equifax 5-year average, and also comparing to the price over sales ratio of 13.6 at the end of 2020, when it just went on the public market through IPO. So now the duration to parity is about 2. If it can continue its compounded annual growth rate of 85%. Of course, from quarter to quarter, there will be very little growth in the remainder of this year if interest rate is going to continue to rise. Where the interest rate will land, I don't think anyone really knows. However, I can say with confidence that the interest rate will stabilize at a certain point. I believe Upstart will continue to grow given its growth story is still intact with a stable interest rate environment and with its quality product in assessing credit and default risks, as well as its increased footprint in auto dealers as well as banking partners. Given its high risk and uncertainty, I will add gradually Upstart stock to my portfolio. This concludes this episode of Quest for Twice. Until next time, happy investing.